the Mad Money. Welcome to Cramerica. My friends, I'm just trying to save a little money. My job is not just to entertain you, but to educate, to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. All right, it's time. We need to start worrying about the froth. I've been willing to look the other way on this issue because I figured speculative stocks would keep roaring because the public wants them badly enough to pay almost any price. But after a day where the Dow dipped 172 points, the S&P declined 0.28%, NASDAQ shed 0.33%, I think it's time to figure out how many of these red-hot stocks have overshot what they might be worth, not just today, but at any point in the future. Why the change of heart? Two reasons. The first, it comes from a person I revere greatly, Fed Chairman Jay Powell. Yesterday in a speech in Providence, Rhode Island, Powell was asked about how the Fed feels about higher stock prices. He talked about how they look at overall financial conditions, and he went on to say that, quote, by many measures, for example, equity prices are fairly highly valued, end quote. Now, I have no doubt that there's a whole cohort of stocks that are let's say far more than fairly highly valued. That's the cohort of speculative stocks. Now, I know that many of the stocks connected to the growth of the data center, that's what everyone talks about these days, NVIDIA, Meta, Alphabet, are regarded as expensive by many of you. But when it comes to actual earnings per share, what we care about in Cramerica, believe it or not, they're honestly not all that out of whack. Yeah, that's right. Speaking of the entire market, the S&P 500 is trading at roughly 25 times this year, 22 times next year's earnings. That's on the higher side, but it's not that expensive. And a lot of these stocks that I just mentioned, they're within that cohort. I can live with the S&P trading at 25 times this year's earnings, knowing that the earnings are going up and the market will look cheaper next year. And that's particularly the case with stocks like NVIDIA. But I don't know if I can keep living with the rally in the speculative stocks, the ones that don't make any money or make barely the amount of money, that have lost money for years, which brings me to my second catalyst, the lightning round. Now, I got to tell you, I've been very permissive about speculative names on this show, saying that I condone owning one super risky stock in a 5-stock portfolio, part of the savings program I suggest in how to make money in any market. And this comes out next week, people. I'm signing books next Tuesday at noon in Manhattan at the Barnes & Noble on 555 Fifth Avenue. If you want to say hi, I'd love to see you. Now, in the book, I even endorse owning 2 specs if you're in a 5-stock portfolio, if you're younger, because then you got your whole life ahead of you to earn back any potential losses. I make a point of saying how important speculation is for you to do. But you got to do it wisely. And I tell you what wisely means. And most people don't speculate wisely. But, man, if the lightning round's indicative of what people are buying, we got a real problem. Monday's lightning round felt like all the recent lightning rounds that I've been going through. We keep getting a slew of speculative stocks. That's fine. You call. I want to help you. They test the bounds, though, of my risk tolerance. And they should test the bounds of your risk tolerance, too. On Monday, I was asked about a host of companies that I think are risky as all get out. 2 examples. Energy Fuels. You. That is a uranium company that's great at both losing money and hitting the 52-week high list. Now, I'm a big believer in nuclear power. I'm not a big believer that nuclear power is going to experience a near-term renaissance. It could take a decade to build a new nuclear plant in this country. So I question if this stock should be up over 215% for the year. I do not question that this stock is, in the words of Fed Powell, fairly highly valued. Why the heck then did I say UUU was okay? UUU was okay. Well, that was because of the spectacular rally in Oklo, OKLO, another nuclear stock that I've been recommending. It's up 518% for the year. When Oklo was in the 30s, I said that one good headline could propel this stock to the stratosphere. Now it's in the 130s. Sure enough, we got that whole slew of headlines about a $1.68 billion facility in Tennessee where Oklo will be recycling nuclear waste into fuel for its advanced reactors. Stock went to a high of 144 today before reversing hard, finishing at 131. I think Oklo is a great concept. And I say concept because it has no revenues. But I think with Oklo, here we go, okay? Am I clear? We got good news today, and the stock couldn't maintain its momentum. That's a bad sign. The intraday reversal, suboptimal. Then I got a question about AST Space Mobile. That's a satellite broadband network for smartphones with a stock that's up 158% for the year. This is a company that's been losing money hand over fist. Almost no revenue whatsoever. Maybe they have something, but it surely isn't self-evident. Sell. I finished the show Monday and went to see my research director, Ben Stoto, who celebrated his birthday today. I told him I was heartsick. I told him that I'm now giving so much license to these stocks that it's just going to end up hurting people. I know that so far it hasn't been a problem. And look, I've been right to recommend them. Dead right. If you've been speculating in these stocks, you've won big. But I can't do it anymore, people. I told Ben I couldn't live with myself if I kept pushing these specs at these elevated prices, and he agreed. We both decided time to rein it in. What else needs to be reined in? Okay, listen to this. We ran a screen today of U.S. listed stocks worth more than $500 million that have rallied at least 50% in the month of September. We came up with 55 names. Get this, only 6 were profitable. That's ridiculous. More importantly, it is worrisome. What sectors count as speculative here? Okay, they can be pretty easily grouped, thankfully. There are the nuclear stocks like Energy Fuels. That means Oklo, Nano Nuclear, and BWX Technologies. I'd include Bloom Energy, BE. I saw them on TV today, which is hydrogen fuel cells. BWX and Bloom make money. The rest don't, but they're all expensive. Then there's the crypto derivatives that want to emulate the success of the company formerly known as MicroStrategy, now called Strategy. They only work if crypto can keep climbing, something that we're going to discuss later on in the show, and it's not positive. Now, if you want crypto, do not buy these. Go buy crypto. The best way to play crypto is with crypto. All right, let's think about quantum computing, which is rife with money losers that could end up being terrific, but right now they don't have much going for them other than hope. That includes IONQ, which we had on the other day. Boy, I liked what I saw. I really did. But only if you think very, very long term. Stock's up 77% for the year. I think that's aggressive. There's D-Wave, which impressed me when they were on, too. It hit a 52-week high today, but it was up 230% for the year. But again, it could be ages before the business starts to take off. I don't even know if they disagree with that. Both IONQ and D-Wave are losing fortunes. Same goes for Rigetti Computing and Quantum Computing, although the latter's only up 29%. Ooh, bargain. What else? There are the companies that look like CoreWeave. CoreWeave is a great company that keeps winning business almost daily, and I've been supporting that one. But then there's a company like Nebius, which has some good contacts and a relationship with Microsoft, but it loses a lot of money, yet its stocks rallied more than 308% for the year. Ow. There are other companies like IREN, which makes power centers for Bitcoin mining and is looking to pivot to AI data centers. Hey, listen, CoreWeave took that strategy. IREN is actually profitable, but its stock has rallied 380%, too hot. Remember, if you want CoreWeave, buy CoreWeave. Finally, there are companies that create flying cars and novel drones and rockets, and of course, the requisite clinical stage biotechs, which often have stocks that soar higher as their losses grow exponentially. You see them sometimes in what's known as the crawl at the bottom when you come in the morning. Stocks are up like 20, 30, 40, 50%. No, I'm done with that. I've enjoyed blessing these speculative names, and so far, it's great. It's been incredibly right. But after that soul-searching lightning round and the words from Jay Powell, I'm going to be adjusting my view. I won't go against the dictum of one speculative stock per portfolio, and it's got to be invested in wisely, as I described in How to Make Money in Any Market. But the bottom line, I can no longer be so sanguine about these super speculative stocks that keep roaring around here. I can no longer just say, it's going higher. I will be more circumspect in the future. And I will say, if I think something's too risky to speculate on, unless you're prepared to lose your entire investment, well, that's what you may do. Because from these elevated levels, a big decline will crush you, and you won't be able to come back from it. And like people in 2000, you will stop owning stocks altogether, and you'll never get rich from the stock market. Don in Kentucky. Don.
Hey, Jim, first-time caller. I appreciate you taking it. I hopped in Lulu Athletica at about 3:34 at the beginning of June. And of course, it's plummeted since then. So my question to you is, would you back it up and try to climb back out of it, or would you just get rid of it altogether?
Well, I think it has fallen too far. It's down 50%. I think that Calvin McDonald is a person of great wisdom, and I do think that you can catch a bounce. I don't want to say more than that because I think the prices are too expensive, and it's not differentiated enough. And I felt that way when my favorite, Costco, came in hard against Lulu. Let's go to Robert in New York, please. Robert.
Jim, thank you so much for having me. And I want to say to the listeners, we are so lucky to have you.
Robert, you're terrific when you call. I love it. You are always terrific.
Jim,
you give me a pick-me-up.
Because, Jim, the bottom line is you could do anything in this country. Look what you've done. I think about how hard it is to work in life, but you were living out of the back of your car, and you became the #1 guy on Wall Street.
There's a lot of number ones, but I did live in my car
on Wall Street.
Well, thank you.
You're the kindest guy on Wall Street. You really are.
But thank you. It is dangerous. Look, no one ever sets out to live in their car, but if you have to, let me tell you, you know who your best friends are? The police. The police helped me over and over and over again. They always told me to go to the right place to sleep. I am not kidding. They were fantastic. You think they roused me? No. They just said, listen, better to go be with the truckers. I'll never forget that. Over and over again, the police helped me. How can I help you?
Okay, Jim, this next company is the leading manufacturer of backup and prime power generation systems for residential and solar battery storage solutions, advanced power, grid software platforms, battery power tools, everything. Okay, 6 analysts revised their earning estimates upwards in the last 60 days on this stock, and they're expected to report cash flow growth of 21% this year now, Jim. Now, Jim, this is very important for your listeners. Did you know that fewer than 6% of American homes have a whole house standby generator? The outages are all over the place, okay? This company, the guy running it is a very smart guy, and they've only had 3 CEOs since 1958.
Okay, and Robert, which stock is this? Oh, okay. Listen, Robert's spot on. By the way, I do have a Generac because I can't have the refrigerator. I have too many medicines in the refrigerator. It would just break me. So it's a good investment. I think others who realize that the grid is so fraught would be thinking about Generac too. I think you're dead right. I think that stock is a great long-term own. And thank you for the kind words. All right, look, I got to start. I don't know what to say. Do I want to worry about froth? I have to. I can no longer just say to a speculative stock that you tell me, hey, that's good. You got to own that one headline. It's going higher. From now on, we're going to be more circumspect. We've won. We're not going to try to win twice. On Mad Money tonight, Micron sold off today despite a blowout earnings report. So is it giving you a buying opportunity? Let's go deep into that. Then gold and Bitcoin have been on a tear this year to react. Really, they've been reaching new all-time highs. So let's go off the charts to see if that can continue, or maybe there's another place that we have to ka-ching. And is now the right time to start a position in a non-speculative data center stock that's doing well called SiTime? I've got the company's top brass after its 37% rally this year, but it's down very big this year. Maybe it's an opportunity, so stay down today. Wow. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
When a stock runs like crazy into earnings, even great numbers might not be enough to prevent it from selling off. Sell. Just look at Micron, symbol MU. It's a key maker of memory and storage chips that you know I have championed for years now. Going into last night's close, this stock was up 170% from its April lows, including a staggering 40% gain just since the end of August. Oh, it's been a terrific move. As Micron, widely dismissed as a commodity chipmaker, that's the old days, it's finally getting some credit for all the business that they'll see from the AI data center boom. Everybody talks about NVIDIA, and so many of the data center infrastructure plays, they deserve it, but these are big warehouses full of servers, and those servers need storage. They need memory, especially high bandwidth memory. Remember that term, HBM, to keep everything running smoothly, and that means they need Micron, which is why the stock has been nothing short of unstoppable. That is until today. See, last night, Micron reported, when you report after such a huge rally, you're dealing with great expectations. Yeah, like Dickens. So great that it was impossible for the stock to keep climbing, even when the numbers were good. It did climb after the close. We went up to 172, but that was after hours trading. Today, not so hot. But the numbers were good, people. Ignore the trading. No, the numbers were like stellar. Micron's revenue was up 46% year over year, almost 22% from the previous quarter, coming in much better than expected. Their gross margin came in at just under 46%, which was up over 900 basis points from the year before. That's almost impossible to do. Their operating margin was 1,250 basis points. These are insane figures. If you're in the business, you'd be just saying, no wonder the company could earn $3.03 per share when Wall Street was only looking for $2.55 per share. In the previous quarter, Micron earned $1.91. So this was a spectacular pickup from just 3 months ago. Now, with a company like Micron, which is known to have big swings in both directions, swings that investors are always eager to get ahead of, it's not enough to just have good results. You also need to have strong guidance showing Wall Street that the future remains as bright as the past. Micron only gives guidance for one quarter at a time. That's been their tradition. But their outlook for the current quarter was excellent. They're talking substantially higher than expected sales. Think 40 to 47% revenue growth. Management said to expect their gross margins to come in somewhere between 50.5 and 52.5. This used to be a commodity player. Wall Street was only looking for a little more than 45%. Put it all together, and Micron guided for $3.65 to $3.85 per share in earnings this quarter. You know, the analysts were only looking for $3.10. This is quite a beat. On the conference call, Micron's staid CEO Sanjay Mehrotra was about as effusive as he gets, talking about how his business is positioned. He's just such not a hype artist. I love that about him. He said that the company's leadership in advanced technologies, including the high bandwidth memory products for the data center, has enabled a, quote, differentiated product portfolio that offers a strong return on investment for a customer. Differentiated means not commodity. Basically, they are much less of a commodity chip maker than they used to be. Now, Sanjay said that AI-driven demand is accelerating. And importantly, industry DRAM supply remains tight. These DRAM chips, DRAM, are old-fashioned memory. It's the most commoditized part of the business. And as long as inventory remains tight, then the business will be fine. He then dug into the company's various end markets, and to no surprise, it's Micron's products for the data center that are driving these incredible numbers. Mehrotra noted that the combined revenue from just three types of products that are popular in the data center, high bandwidth memory, high capacity DRAM products, and low power DRAM products, ones that don't burn so bad, reached $10 billion in their fiscal 2025 year, in their 2025 fiscal year, which just ended in August. This was a five-fold increase versus the year before. On top of that, Mehrotra said, quote, in addition to being a demand driver, AI is also a powerful productivity driver for Micron. Yes, Micron itself, explaining that the company's using AI throughout its entire production process, from design to technology development to manufacturing. This is why they've been so good at profiting from the data center, because they're speeding up the design and production process to get the hyperscalers the hardware that they need. By the way, you also talked about gigantic use cases developing with AI, like code writing, like agentics. That's the process of AI-driven agents helping you instead of people. People are more expensive than the agentics. Mehrotra talked about 1-gamma DRAM products, which Micron began shipping earlier this year. As was the ramping production of 1-gamma DRAM products, the company's manufacturing process became efficient and dependable in record time, 50% faster, 5.0, than the previous generation. In short, Micron is not just riding the data center wave like everybody else. They're actively innovating and getting products that are ideally suited for the data center to market faster than the competition. And by the way, just so you know, these guys used to be behind a lot of the companies, like in Japan. They're now ahead of them. And look, as strong as data center business is, it's not just the data center. Micron's other top-end markets are also looking pretty good at this point, even if they're not putting up the insane numbers like anything connected to AI. For example, the company took up its expectations for PC unit shipments. They were previously expecting a low single-digit percentage increase, but now they're talking about mid-single-digit growth for the 2025 calendar year. A lot of that is Micron's benefit is that Windows 10 is being phased out. So in other words, Microsoft change is driving more business for PCs. In smartphones, management said that, quote, an increasing mix of AI-ready smartphones continue to be a key catalyst for DRAM content growth in mobile devices, end quote. Apparently, one-third of flagship smartphones shipped in the second quarter contained 12 gigabits of more DRAM content, which is a lot. Listen to this. Quote, given recent product launches from Apple, Samsung, and other smartphone OEMs, we expect this mix to increase over the coming quarters, end quote. In short, the smarter your phone gets, the more of these memory chips it needs. And Sanjay kind of intimated to me when I asked about this morning that, well, these companies are doing very, very well, including Apple. Much better than I think people thought they were going to be doing. Even in the automotive and industrial market, which has been one of Micron's weakest areas, management said, quote, demand strengthened throughout the quarter, end quote, exceeding our forecast. Now, Micron's also seeing better profitability in auto and industrial thanks to better pricing and more demand for higher tech products. Still, after the stock jumped higher and after hours trading last night, Micron ultimately pulled back almost 3% today. Sell. Again, this should not have been a surprise, given that the stock was up 40% in the 3.5 weeks before the quarter. But the bottom line, coming into Micron's earnings, I was wondering if the company could report anything that could justify the stock's incredible run. You know what? That's exactly what they did. After this titanic quarter, I think Micron can keep running. I just hope we get more pullbacks like this so that you can buy it on weakness. Yes, the Micron quarter really was that good. Mad Money's back after the break.
Coming up, is all that's traded truly golden? Cramer's going off the charts and looking at the price action of both gold and Bitcoin. Next.
I'm always telling you to own some gold. Maybe the actual metal, maybe the GLD, maybe a minor, because it's a great hedge against both inflation and economic chaos. But gold's had an incredible run this year, up 42% for 2025. Spectacular move. If you are owning the precious metal as a kind of insurance policy like I've been recommending, well, your insurance is paid out. Given how much gold has rallied, though, does it make sense to keep sticking with it? Or could this be the right time to ring the register? This is a question that's torturing me. Now, it's a tricky moment for the economy. So I have a hard time predicting whether the macro situation will start favoring precious metals in, say, 6 to 9 months. But there's another way to approach this. And that's why tonight we're going off the charts with the help of Larry Williams, the legendary technician and market historian who's been the best in the business since I was a teenager. Larry's written over a dozen books and created a ton of proprietary technical indicators I use all the time. Maybe you do too if you're a technician. He's also made some incredible calls in the last few years on this show. His track record unassailable. So when he tells us that gold is headed lower, well, you better believe we got to take him seriously. What makes him bearish on the precious metal? Well, he's got some charts that show us what you'll be shaking when you're finished with this one. First, let's do a historical exercise. Take a look at this weekly chart of the gold futures from a few years ago with something called total open interest down at the bottom. That index, the black line in the following chart, shows how many futures contracts are open. It reflects the total number of positions outstanding in the gold futures market at any given time. At the same time, each week we also get to see the total net number of open positions, held by what are known as commercial hedges. These are companies that either produce or use gold, the actual traders, right? The real guys. Larry's a big believer in tracking the behavior of the commercials because they understand the commodity better than anybody else. They have to buy or sell gold as part of their day-to-day business. They're not just speculators, and that gives them a unique insight. So we really want to focus on the commercials, all right? Now, if total open interest in gold futures is rising, but the futures contracts held by commercial hedgers are falling, that means people buying gold are speculators, either individuals or professional money managers. As Larry sees it, that's a bad sign because the commercial interests, they're the ones who are best informed. They know the most, and they seem to have no interest in gold. That's very, very worrisome. You should be very concerned when you see the commercials have no interest. We saw this pattern in the start of 2022 when the total open interest had a dramatic rise while the commercials were selling gold futures aggressively. Larry says this is a typical pattern you see when you get a market peak. The smaller blue ellipses, they illustrate the same pattern. When there's an increase in open interest not driven by the red line of informed money from the commercials, the price of gold tends to decline. Why is this so important? Well, take a look at the weekly chart of gold this year with the same total open interest data we saw in the last one. When you look at the current activity in the gold futures, we're seeing much higher open interest, more people trading the futures. But the commercials, what are they doing? They're selling. They're not buying. It's the same pattern we saw back in 2022. That marked the peak in gold prices. Larry points out that we saw the opposite of this at the beginning of the year. This is really cool. Right here, right? The black line was declining. All right. But look at this thing, meaning less futures activity overall. But the red line roared. OK, so then you see we start going up. And then what happened is you get this black line down, red line up. And that's when the big rally started. That preceded a magnificent rally in the shining stuff. You wanted to catch this one, all right? Now that pattern has flipped, and Larry believes that we're going to have a potentially ugly decline because of the commercials. That's not all. Take a look at this chart of gold prices with the average seasonal pattern down in blue at the bottom. Larry's always looking for these cycles that repeat themselves over and over, including how commodities tend to trade at any given point in the year. And hey, when you look at the seasonal pattern in gold, this time of the year is about when we would expect the yellow metal to naturally have a pullback. You can see about where it would be going, that's the seasonal, and where it is right now. So you would think it would track that. That's what he's saying. What else? When Larry digs into the longer-term historical cycles for gold, he says the strongest one is the 8-year cycle. That's the blue line on this next chart. As you can see, gold tends to follow this 8-year pattern pretty darn closely. And right now, that cycle says that the gold prices will likely head lower through early next year. Okay? These cycle forecasts are not exact science, but they tend to be a solid roadmap for the direction where prices are likely headed. And it's not good news for gold, especially after this run, people. I mean, look at this. It's not unusual to expect this, and you're going to get it, Larry says. Okay, what about digital gold? Ooh, I know you'll love this. What about Bitcoin? Regular viewers know that I've been a huge fan of crypto for years, but Larry points out that gold bugs and Bitcoin bugs have a lot in common. Both distrust the dollar, both want privacy, and both tend to doubt the Federal Reserve. But there are no commercial uses for Bitcoin, and you can't melt it down and sell it to a pawn shop. That's why Larry's not totally sold on the idea that Bitcoin's a digital replacement for gold. It's much more that it appeals to the same constituency as gold. In reality, though, it's a market driven largely by emotion. Still, Larry found a value relationship between Grayscale Bitcoin Trust, that's that GBTC that those who trade this know very well, where they have the most historical data on Bitcoin prices, and the dollar index, which measures the greenback against a basket of foreign currencies. Take a look at the weekly chart of GBTC with Larry's valuation model relative to the dollar index down at the bottom. While not exactly a timing tool, he says this has been a good way to understand when to expect major moves in Bitcoin. Recently, GBTC was overvalued relative to the dollar, okay, which suggests a decline might be coming. So how can we time the move? Well, take a look at this chart of GBTC with Larry's cycle forecast in red and blue. The red line is the shorter-term cycle. It seems to repeat itself, while the blue line represents a longer-term cycle. Right now, they both point to lower prices for Bitcoin. Wow. Like gold, Larry thinks it's possible this week this could last through the first couple of months of next year. So you see that this is where 26 is. It does go back up, but this is what we're focused on, right? We don't want to get hit by this thing. Here's the bottom line. The charts interpreted by Larry Williams suggest that both gold and Bitcoin could be headed lower for the rest of the year. Remember, we didn't really get a good look at 2026. Rest of the year is what I'm concerned about. Given his track record, I certainly wouldn't bet against Larry Williams. There are so many other things that are working in this market. No need to stick your neck out for something that Larry has warned you away from. It's always fraud when you go against this man. Let's go to Jeremy in North Carolina. Jeremy.
Big hump day. Booyah to you, Jimbo.
Man, I'm liking the way you came in fired up. You're coming in hot. Let's go to work.
Yeah, thanks for all you do. I'm down about 15% on this PARC acronym name since you so cleverly came up with it. Jim, is Coinbase going to get out of reverse and into drive with the rest of its PARC cohort?
Okay. All right. I want to take a longer-term view on Coinbase because I think that they, in the end, were the first. I know there's bullish, but Coinbase stuck its neck out and went out, and all the other firms avoided them or almost isolated them, the typical brokerages. Well, now they these guys laugh last. I think you just own Coinbase. Don't trade it. Not for a long time, but right now. Rich in California, Rich.
Hey, Jim, this is Rich and Cindy with a double booyah. Make that a quadruple booyah because of your perseverance and fortitude. You've encouraged us on. We rode the roller coaster through several equities, but right now, we'd like to know what your feelings are on Hershey.
Okay, I think Hershey is an unassailable position in that commodity prices are, I think cocoa's peaked. What matters is that no one's ever come in to beat these guys. A lot of people want to be in it for a takeover. Forget the takeover. It's more of an earnings play. It's one of the few food stocks that are doing well. I think that can continue. Let's go to Leslie in California, please. Leslie.
Jim, club member. Here's
Excellent.
a piece of cake for you, Jim. GE Verona, buy, sell, or hold.
Man, I like GE Vernova. GE Vernova is a company that makes the natural gas turbines that are needed for so much, including the data center. That's why it's been red hot. It is one of the names I have and own for my Travel Trust, which, of course, you can follow along by joining the CNBC Investing Club. All right, now this is really important for you gold bugs out there like me and for your crypto guys like me. The charts, according to Larry Williams, suggest that gold and Bitcoin are just going lower the rest of the year. I don't want to agree with him, but I think it's hard to bet against Larry. Okay, much more money, including my sit-down with a real niche player that's doing so well called SideTime. This under-the-radar player is involved in end markets spanning from data centers to smartphones. I got the CEO for the update on how business is faring. Then, has the spending spree surrounding the data center gotten out of hand? Well, I'm sharing where I come down about as the AI build-out reaches new levels. And all your calls rapid fire tonight is just the lightning round. So stay with Cramer. Right, what do you make of this volatile action in SiTime? That's the maker of timing chips used in everything from smartphones to data centers to planes and automobiles. Here's a stock that's up nearly 40% year to date, 155% since we spoke to them in 2023. Anything connected to data center has been on fire lately, including these increasingly essential timing chips. But today the stock pulled back more than 7%. Look, I think it was profit taking, okay? It hit a new time. It just hit a new all-time high. But what do we do? Let's check in with Rajesh Vashisth. And Rajesh is the chairman, CEO of SiTime to learn. So Rajesh, welcome back to Mad Money.
Well, thank you so much for having me.
Okay, so first I want to establish, and I don't mean to use you, it's not fair, but people who traded your stock, every time we have one of these traded meetings, they sold. How did they do versus if you just owned the stock?
Well, listen, we went public 2019 at $13 a share.
13.
1-3.
All right.
13. And today we are about 300. I didn't see where we ended, but we are around 300. That's an amazing amount of growth for a stock for this company that's just six years old in terms of.
Right. So, I mean, ideally, what people have to recognize is it is volatile, but that doesn't mean that it should be avoided. It's been a remarkable performer.
Yeah, and particularly when you add to it that we are one of the most diversified companies. We have 400 different applications, and we sell all across. As you said, we sell in AI, we sell in consumer, we sell in military aerospace, automobiles, all of those places.
So basically I was talking with someone, we were talking about who is your competition. Frankly, I don't know if there's, at this point, you've kind of exceeded all the other competitors. You seem to be, for instance, in the data center, the only game in town.
Well, I always have a lot of respect for competition. This industry has been serviced by non-semiconductors,
right.
Quartz, 100 years. We're displacing.
Quartz like you see in a watch.
Exactly. And they've been very successful, very good at it. But along comes SiTime, which is not so much intent in replacing Quartz
right.
as finding new use cases wherever there's connectivity, wherever there's intelligence, sensors, mobility, all of that.
Well, you're talking about 40% growth?
That's right.
How's that possible?
Well, it's a large market, $11 billion TAM, and SiTime is a key player in this. We invented the category. We invented precision timing. So you know how it is. When you create a category, you get to win.
Now, something that since we talked to each other last, the resonator is gigantic. So
That's
tell
right.
people when I say the resonator, what that means.
Well, the resonator is truly the vibrating element. You and I are used to semiconductors that are circuits. Well, this is a moving part in silicon. And you said it right. You said gigantic. We made a play on it as well. We call it Titan because it's so tiny. So it's the opposite. It's 0.4 by 0.4 millimeter. Right over there, you can see how tiny it is. It's one-fourth the size of quartz crystal.
Well, can that be in things like hearing aids?
It's in hearing aids. It's in wearables. It's in Internet of Things. It's in cars. Think in tire pressure monitoring systems. It's ubiquitous. 40 billion of these are sold.
Wow. Now, before that, things couldn't be miniaturized, could they?
No, because you are with quartz crystal, and also you don't get the quality, the reliability, you don't get the supply chain, you don't get the low power semiconductors.
Right. So when this data center theme, it was really the subject of a lot of to and fro today, where the people say, listen, there's not enough money to spend to be able to do it. My friend Renee Haas from ARM Holdings, I asked him, he said, look, the demand is just really incredible. So you have to kind of build it because they are coming. Do you see that too? I mean, do you see,
Absolutely.
For instance, you have a very large customer that is not necessarily in the data center, but has a lot of AI. That the AI thesis is spot on.
That's right. And remember that in AI, we have about 70 different kinds of customers with about 20 different applications. It's not about the GPU only. It's about the switches, the accelerator cards, the cables, the optical modules, all of that. That's where the SiTime is. And as you said, we do see the demand, and we see that the demand is pulling through, and to the best of our knowledge, it's true demand.
Okay, now this large customer, I know you're not going to mention the customer's name, but we spend a lot of time with companies that do great cell phone work. And there just seems to be an acceleration in demand for cell phones. Now, we've had a hard time believing that since analysts all over the world were telling us it's peaked. I think that when you add AI to it and add some of the brains that you put into it, it's exciting people again. And people are buying them like they haven't bought in a long time.
Yeah, we see that, these people who disassemble phones are showing us that in some of the more popular phones, as you said, the modem has the timing chip from SiTime.
Right.
That's a really, really clear place. Wherever the modem goes, hopefully that's where we'll go.
Now, if they didn't have it, if they had an older version, if they had somebody else's, what would it not be able to do that yours can?
Well, you never quite know what exactly it enables, but in the long run, it enables size, it enables small size, lower power, greater functionality. Lower power, lower latency. Right?
Okay, right.
All the stuff. So like I said, connectivity, speeds, intelligence, sensing, that's what we do under real tough environmental conditions, shock, vibration. We sustain 50 times better, lower power, supply chain.
All right, so my last question. Sanjay Mehrotra is a friend who's on this morning, School of the Street. I've been talking with him about competitors for a very long time, and they've got really big competitors, Japan, they've got Korea. There's nobody in Japan doing what you're doing, is there?
Nobody in the world is doing what we're doing in technology, but even more fundamentally, Jim, nobody's doing timing. SiTime, silicon time. That's what we do.
Well, I got to tell you, it's good not to have those big competitors. It's good to own these markets, and I know you're doing it because of sheer dint of will. And by the way, your balance sheet's great, so it's not like they're borrowing money to do it, which is something I've been very concerned about with a lot of companies.
That's right, no debt.
Right, no debt. That's Rajesh Vashist. He's the chairman and CEO of SiTime. Been a big winner. I think he's going to stay a big winner. Don't worry about the volatility. Look at how the stock's done over since 2019. I mean, you're talking about being up so many points. Stop trading. Own. Mad Money's back after the break.
Thank you.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the White Round. Of course, we say let's talk about myself, so to North Coast over there. My step first, the latest out. And then the lightning round is over. Are you ready? Ski Daddy, time for the lightning round. Let's start with Ashton in Maryland. Ashton.
How's it going, Jim?
Going well. How about you?
Good. I watch you in class all the time. Shout out Mr. Marks.
Yeah, Mr. Marks does a great job. Love him. Yeah, he should be my hey, how to make money in any market should be his textbook. Go ahead.
I'm calling about Taiwan Semiconductor Manufacturing. The ticker's TSM.
TSM. Okay, now my problem with TSM is it's going up much more of late than Nvidia. I'd rather see you be Nvidia and Taiwan Semi. Don't have that what I call the foreign risk profile. Let's go to Ilham. Ilham in Virginia. Ilham.
Thank you very much, Jim, for taking the call and valuable advice. As a club member, receiving a good signals.
Thank you. Thank you very much.
My stock is one of your recommendations, which was 220, and now it's a little bit down. I have a few hundred, and I want to know your advice. Should I hold it or should I buy more? It's now 209, I guess. The stock name is Honeywell.
Okay, Honeywell's part of a whole cohort of industrials that just keeps going down, and I don't know what to say other than the fact that we're holding on. We probably, when I talked about this with Jeff Marks this morning, probably looking at 202, 204 to buy more. Not before then. This group is so problematic. I'm going to let the pitch come to me. Let's go to Rami in Florida. Rami.
Jim, thanks for all you do.
Of course.
It's like Rodney Dangerfield. This stock has no respect, but like Dangerfield, it's going to make a lot of money.
Okay.
Western Digital.
Okay, so after what happened today with Micron, where it reported an unbelievable quarter and it still went down, we're going to have to wait for Western Digital. You're absolutely right. They are doing fabulously. That was very clear from the Micron conference call just last night. But now we got to wait because people are going to get a little skittish. They'll take the stock down. I bet you can buy that stock at 100 not that long from now. Let's go to Otis in Illinois. Otis.
Yeah, Jim, grateful first-timer here. Thanks for fielding the call.
Fantastic. Thank you. Thank you. How can I help?
Yeah, 19 years ago, my dad and I tuned into a clairvoyant Jim Cramer who spotted an American manufacturer of industrial equipment tied to water And I started a position that's since been a stellar performer. And I'm just curious, Jim, 2 decades later, should I just forever hold on to my rarely mentioned stock of Watts Water Technologies?
The answer is yes. I think that this is a company that is exactly the kind of thing that you don't want to trade it. You want to own it. It's just a great American manufacturer. Stay long. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Sometimes you see something from someone real smart in this business that takes your breath away. Often that someone is Michael Semlis. He's the keeper of the brilliant Eye on the Market newsletter, chairman of market and investment strategy for JP Morgan Asset and Wealth Management. This time, for the Eye, he made up a poster fake movie. The tagline, indestructible, indescribable, it cannot be stopped, the data center blob. And it tells us this horror movie promises to cover strained power grid, higher nighttime loads, higher power prices, and so much more. It stars Amazon Web Services, Microsoft Azure, Google Cloud, Meta, and the amount of money being spent on the movie is insane. Now, of course, Michael's being facetious here, but he makes a point that chilled me. AI-related stocks have accounted for 75% of the S&P 500's returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November of 2022. That's incredible. It means 2 things. One is that there really is a new industrial revolution, as NVIDIA CEO Jensen Huang suggested would happen when I first talked about it 7 years ago. But 2 is that there isn't all that much growth in the economy away from AI. Housing, infrastructure, office construction is all being eclipsed by the data center spending. And I think that will probably continue to be the case because I don't see the build-out stopping anytime soon. Maybe the Fed needs to understand there are 2 economies, one that's a data center doing well. The other, the rest of the economy, needs more rate cuts. This morning on Squawk on the Street, we interviewed Sanjay Mehrotra from Micron with his breakout quarter I talked about earlier. But we also talked to Renee Haas, the CEO of ARM Holdings, an integral part of all things digital, from cell phones, personal computers, to the servers that make up the data center. With Semlis data center blob movie in mind, I asked Haas about where all the money could come from that's got to be spent. Maybe there'd be a winner take all, loser take none situation. Renee doesn't mince words. He thinks that demand is driving that the data spending, and the demand's so strong that every penny's justified. I know that as long as the data center spending is self-funded, not related to debt, we got a solid chance to avoid a bubble. It wasn't until Oracle's announcement of nearly $500 billion in orders that I myself started to worry. We quickly learned that a significant portion of those orders came from OpenAI, and I don't know how OpenAI can raise the money it needs without taking on huge amounts of debt. Although this week, NVIDIA committed investing $100 billion in their expansion over time, but not up front. I heard critics say this deal is what's known as circular or vendor finance, meaning a supplier giving a customer money to buy product. I look at it very differently. I think NVIDIA is making a very smart investment in OpenAI, which could end up being worth $1 trillion when it comes public, maybe more. It could give NVIDIA a monster return. The deal makes sense for both sides, which is really what matters. Now, by the way, lots of stories flying around everywhere about investments like Intel asking for money from Apple, and I'll believe it when I see it. While I still believe AI represents a new industrial revolution, I do fear the data center blob. I'd feel much better about all of the spending if we were done with existing cash flow from publicly traded companies. Once we jump that, and I feel we're in danger of doing that with OpenAI, even as it is doing incredibly well, then we are in a much higher risk situation. One that makes me fear that when I see the data center blob, I'll have to hide my eyes because maybe it's a documentary. I like to say there's always a bull market somewhere. I promise to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.